There's an economist that Western leaders don't want you to know about. An economist whose models predict the collapse of everything the West has built over the last 75 years. An economist who's been right about every major economic shift of the past 2 decades while everyone else was wrong. And the terrifying part? This economist doesn't work in Washington, London, or Brussels. They work in Beijing, and everything they've predicted is coming true. Today, I'm going to tell you about the person who's rewriting the rules of global economics while the West sleeps, about the theories that make central bankers break out in cold sweats, about the predictions that, if true, mean everything you know about money, power, and the global order is about to be turned upside down. But before we get into who this person is and what makes them so dangerous, let me tell you about the moment when Western officials realized they had a problem. A moment when one presentation in a closed-door meeting made some of the most powerful people in global finance understand that they were playing yesterday's game. It's 2019, the annual meetings of the International Monetary Fund in Washington, D.C. Hundreds of finance ministers, central bankers, and economists from around the world gathering to discuss the state of the global economy. The official sessions are boring, PowerPoints about GDP growth and inflation targets, the usual stuff. But there's always a private session, a meeting within the meeting where the real conversations happen, where people speak freely without cameras or press releases. And at this particular meeting, a Chinese economist was invited to present. Most of the Western officials didn't know who this person was. They'd seen the name on academic papers. They knew this economist had advised the Chinese government on various initiatives, but they weren't prepared for what they were about to hear. The presentation started simply enough. An analysis of global capital flows, where money was moving, why it was moving, what it meant for the international monetary system, standard stuff for an IMF meeting. But then the economists started showing projections, not for 1 year or 5 years, but for 20, 30, 50 years out. And these projections showed something that nobody in that room wanted to see. They showed the dollar losing its reserve currency status, not suddenly, not in a crisis, but gradually, systematically, inevitably. They showed Chinese GDP surpassing American GDP, not just in nominal terms, which everyone expected, but in technological sophistication, in innovation, in the metrics that actually matter for long-term power. They showed a world where the institutions that have governed global finance since World War II, the IMF, the World Bank, the entire Bretton Woods system become irrelevant, replaced by new institutions, new currencies, new rules written by different powers. One of the American officials in the room asked the obvious question. This assumes China continues growing at rates that are historically unprecedented. What if China slows down? What if China faces a debt crisis? What if the demographic problems sink the Chinese economy? The economist smiled. And this is the part that I heard from 3 different people who were in that room. The economist said, "You're thinking about this wrong. You're assuming China needs to be perfect. We don't. We just need to be better than you. And right now, you're making it very easy." The room went silent. Then the economist continued. They pulled up data showing Western debt levels, government debt, corporate debt, household debt, all at record highs. They showed productivity growth stalling across the developed world. They showed infrastructure crumbling, education systems falling behind, political polarization making coherent policy impossible. And then they showed what China was doing. The Belt and Road Initiative creating new trade routes and economic dependencies. Massive investments in artificial intelligence, quantum computing, biotechnology. A social and political system that, whatever you think of it morally, can execute long-term plans without worrying about election cycles. The economist's argument was simple but devastating. The West is optimized for consumption and short-term returns. China is optimized for production and long-term positioning. In a competition between those two systems, production wins, always, eventually. One of the European central bankers pushed back. They said that China's system is brittle, that it depends on authoritarian control which stifles innovation, that free societies with open debate and creative destruction will always out-innovate command economies. The economist didn't disagree entirely. They said yes, open systems are better at innovation in many ways. But they asked, what good is innovation if you can't scale it? What good is inventing something if someone else manufactures it? controls the supply chain, and captures most of the value? They pointed out that many of the most important technologies of the 21st century were invented in the West but are now dominated by China. Solar panels, batteries, electric vehicles, 5G infrastructure. The West invented the science. China turned it into industries. And then the Economist said something that apparently made several people in the room visibly uncomfortable. They said, "You think you're competing with China. You're not. You're competing with history. And history says that manufacturing power determines global power. Always has. Always will. You've outsourced your manufacturing power, and now you're surprised that you're losing economic power. This isn't complicated." After the presentation, Western officials huddled together, trying to figure out what to do with this information. Some dismissed it as Chinese propaganda. Some said the models were too pessimistic. Some said there was no way the transitions would happen as smoothly as the projections assumed. But a few, the ones who actually understood what they'd just heard, were terrified. Because the thing about this economist's work is that it's not based on ideology. It's based on data, on historical patterns, on cold mathematical models of how economic systems evolve. So who is this person? I'm going to protect some anonymity here because people who speak too openly about these topics have a way of finding their careers curtailed. But I can tell you this. They trained at top Western universities. They worked at Western financial institutions. They understand the Western economic system better than most Western economists do. And then they went back to China and brought that knowledge with them. They're now part of a generation of Chinese economists who combine Western training with Chinese government access, who can speak the language of markets and the language of state planning, who understand both systems and are using that knowledge to build something new. The core of this economist's theory is what they call productive primacy. The idea is simple. In the long run, the country that makes things has more power than the country that buys things. Financial engineering, service economies, even technological innovation, all of these are secondary to the fundamental question of who controls production. The West, according to this theory, made a catastrophic mistake in the 1980s and 1990s. We decided that we could have a post-industrial economy, that we could offshore manufacturing to low-cost countries and focus on high-value services and innovation, that we could be the brains while the rest of the world was the brawn. And for a while, it worked. Western companies made enormous profits. Western consumers got cheap goods. Western stock markets soared. But we were selling off the foundation of our power without realizing it. Because here's what the Economist understood that Western policymakers didn't. Manufacturing isn't just about making stuff. It's about supply chain control. It's about the engineering knowledge that comes from solving production problems. It's about the ability to scale innovations. It's about the strategic independence that comes from not depending on others for critical goods. When you offshore manufacturing, you offshore all of that. And once it's gone, it's incredibly hard to get back. Because manufacturing capability isn't just factories. It's the ecosystem of suppliers, the workforce with the right skills, the institutional knowledge about how to make things efficiently. China understood this. While Western economists were celebrating the service economy and the knowledge economy, Chinese planners were focused on moving up the manufacturing value chain. From toys to electronics to cars to semiconductors, each step more sophisticated than the last. The Economist's projections show that by 2035, China will control the majority of global manufacturing capacity in most advanced technology sectors, not because they invented those technologies, but because they built the capacity to produce them at scale. And once you control production, everything else follows. You set the standards. You control the supply chains. You have leverage over countries that depend on your products. You accumulate the technical knowledge that leads to the next wave of innovation. This is what terrifies Western officials. Not that China might catch up, but that the game might already be over, and we just don't realize it yet. Let me give you a concrete example that The Economist uses: semiconductors, the most critical technology of the 21st century. The West, particularly the United States, still has an edge in chip design. Companies like NVIDIA, AMD, Intel design the most advanced chips in the world. But who makes those chips? TSMC in Taiwan, Samsung in South Korea, and increasingly, Chinese fabs that are catching up fast. The West designs, Asia manufactures, and The Economist's question is, How long can you maintain a design advantage when someone else controls manufacturing? Because manufacturing is where you learn. When you're actually making chips, you discover problems and solutions that designers never anticipated. You develop proprietary processes. You build expertise that can't be captured in blueprints. China is pouring hundreds of billions of dollars into semiconductor manufacturing, not because they expect to catch up immediately, but because they understand that controlling manufacturing is the path to controlling the technology. The Economist predicts that by 2040, China will be producing semiconductors that are competitive with anything the West can design. And at that point, the last major technological advantage the West has evaporates. Western officials who've engaged with this Economist's work have tried to poke holes in it. They argue that China faces demographic collapse. An aging population, a shrinking workforce. How can you build a dominant economy when your population is declining? The Economist's response is that demographics matter, but they're not destiny. Japan has terrible demographics, but is still the third largest economy in the world. And besides, the economy of the future is less labor-intensive. Automation, AI, robotics, these technologies mean you can produce more with fewer people. China is leading the world in industrial robot deployment. They're installing more robots than the rest of the world combined. They're building automated factories that run 24 hours a day with minimal human intervention. In that world, having a billion people matters less than having the best automation technology. Others argue that China's debt levels are unsustainable, that the property sector is collapsing, that local governments are bankrupt, that a financial crisis is inevitable. The Economist doesn't deny any of this. They acknowledge that China has serious economic problems, but they argue that the question isn't whether China has problems. It's whether China's problems are worse than the West's problems. And when you compare Chinese debt to American debt, Chinese infrastructure to American infrastructure, Chinese investment in future technologies to Western investment, the comparison doesn't favor the West. The Economist points out that China's debt is mostly internal, Chinese entities owing money to other Chinese entities. That's manageable in ways that external debt isn't. The West, meanwhile, depends on foreign buyers for its debt. What happens when those buyers lose confidence? But here's where it gets really interesting. The Economist doesn't just predict Chinese dominance. They predict a fundamental restructuring of the global economic system. A move away from the dollar-based Western-led order to something completely different. They call it parallel systems architecture. The idea is that rather than one global economic system with one set of rules, you'll have multiple systems operating simultaneously. A Western system based on dollars, transparency, and market principles. A Chinese system based on yuan, state coordination, and strategic priorities. Other regional systems in India, Latin America, Africa. These systems will interact, but they won't be fully integrated. They'll have different rules, different currencies, different institutions, and countries will participate in multiple systems simultaneously, switching between them based on what serves their interests. This is already happening. Countries use dollars for some transactions, yuan for others. They participate in Western-led institutions like the IMF and Chinese-led institutions like the Asian Infrastructure Investment Bank. They hedge their bets. The Economist predicts this trend will accelerate, that by 2050, the idea of a single global economic order will seem as quaint as the idea of a single global empire. The world will be multipolar economically, just as it's becoming multipolar geopolitically. And in this multipolar world, the Economist argues, China has structural advantages, because China can operate in both systems. Chinese companies can navigate Western markets and Chinese markets. Chinese officials understand both market economics and state planning. The West, meanwhile, only understands one system. We're optimized for markets, for competition, for decentralized decision-making. We're not good at coordinating industrial policy or executing long-term strategic plans. And in a world where both capabilities matter, that's a disadvantage. I've seen Western economists try to rebut these arguments. They point to China's lack of innovation, the flight of capital, the brain drain as educated Chinese move to the West. They argue that authoritarian systems can't compete with free societies in the long run. And you know what? They might be right. The Economist I'm describing might be wrong. China might face a crisis that derails everything. The predictions might not come true. But here's what terrifies Western officials. What if the Economist is even partially right? What if China doesn't dominate completely, but just becomes an equal pole in a multipolar world? What if the dollar doesn't collapse, but just becomes one option among several? Even those milder scenarios represent a massive loss of Western power and privilege, because the entire Western economic model depends on certain assumptions: that the dollar will always be the reserve currency, that Western capital markets will always be the deepest and most liquid, that Western institutions will set the rules. If those assumptions break down, even partially, the consequences are enormous. Higher borrowing costs, less leverage in international negotiations, a smaller share of global economic gains. The Economist has advised Chinese policymakers to be patient, to not trigger a crisis by moving too fast, to let the West's own contradictions play out, to build capabilities quietly while the West argues about culture wars and election cycles. And that's exactly what's happening. While Western political systems are paralyzed by polarization, China is executing multi-decade plans. While Western infrastructure crumbles, China is building new cities and transportation networks. While Western education systems struggle, China is producing millions of engineers and scientists. The Economist's models suggest that the critical inflection point comes around 2030. That's when Chinese technological capabilities in key sectors reach parity or superiority. That's when the Belt and Road investments mature and create new trade patterns. That's when demographic changes in the West become severe enough to impact economic growth. After 2030, according to these models, the trends become very hard to reverse. The advantages compound, the path dependencies lock in, the new order becomes the established order. We're 5 years away from that inflection point, and Western policymakers are only just beginning to wake up to the challenge. The CHIPS Act, the Inflation Reduction Act, the attempts to reshore manufacturing, these are steps in the right direction. But they're reactive, not proactive. They're trying to rebuild capabilities that took decades to offshore. The Economist is skeptical that the West can move fast enough. Not because Western people are less capable, but because Western political systems aren't designed for this kind of long-term, coordinated action. We're good at responding to crises. We're terrible at preventing them. So what should you do with this information? How should you think about your money, your career, your future in light of these predictions? First, understand that we're living through a transition. The world order that's existed since 1945 is breaking down. That creates risks, but also opportunities. The people who recognize the transition early and position themselves accordingly will do much better than those who cling to the old assumptions. Second, diversify geographically. Don't assume that Western markets will always outperform. Don't assume that dollar-denominated assets are always safe. Have exposure to Asian markets, to Chinese growth, to the economies that are rising rather than those managing decline. Third, invest in skills and assets that are valuable in multiple systems. If you speak Chinese, if you understand both Western and Chinese business culture, if you can navigate between different regulatory frameworks, you're valuable in a multipolar world. Fourth, pay attention to manufacturing and production. The Economist is right that production matters. Companies that actually make things, that control supply chains, that have hard assets, these are going to outperform companies that just shuffle paper or provide services. Fifth, expect volatility. Transitions are messy. There will be crises, currency fluctuations, geopolitical tensions. But volatility creates opportunities for those who are prepared. The economist who terrifies the West isn't terrifying because they're predicting doom. They're terrifying because they're predicting change. Fundamental structural change in how the global economy works. And change is always threatening to those who benefit from the status quo. Western elites have had a pretty good run for 75 years. We've set the rules. We've collected the rents. We've enjoyed the privileges that come with being at the center of the global system. The prospect of losing that, even partially, is terrifying. But here's the thing about history. It doesn't care about what you want. It doesn't care about what seems fair. It cares about fundamentals, about productivity, about innovation, about who builds things and who just consumes them. And right now, the fundamentals are shifting, not because of one economist's theories, but because of deep structural changes in technology, demographics, and global power distribution. The Economist just sees those changes more clearly than most. Whether they're right about everything remains to be seen. But they're right about enough that ignoring them would be foolish. The West needs to wake up, not to contain China, but to compete effectively, to rebuild our own capabilities, to remember that economic power comes from making things, not just from financial engineering. The economist who terrifies the West is holding up a mirror, and the reflection shows a civilization that's lost its way, that's forgotten the sources of its own power, that's coasting on past achievements while competitors are building the future. The question is, will we look in that mirror and change, or will we smash the mirror and pretend everything is fine? The clock is ticking, the inflection point approaches, and the economist is watching, taking notes, updating the models. And so far, reality keeps matching the predictions. That's what terrifies the West.